CSP Educational Workshop. My name is Jamie Austin, and today's topic is insurance. With me today is Jonathan Carroll, Vice President of Bradley & Parker. Jonathan has 19 years in the insurance industry and 15 as a licensed broker. Also with me is Aimee DiBartolomeo Cody, President of Premier Benefit Plans. The company was founded in 1995. Aimee joined the company in 1998 and became president in 2005. So both of our guests today have an extensive experience in the insurance industry, and we look forward to hearing what they have to share with us. So welcome, Jonathan and Aimee.
Welcome. Thank you.
All right. It's great to have you both. We are really looking forward to hearing these insights into insurance. Like everybody says, nobody ever wants to talk about insurance, but you guys are going to do it today. So Jonathan, let's start with you. You say helping businesses, you like helping businesses avoid risk by analyzing and solving their problems. So what kind of problems do companies have, and how does insurance play a role in that?
Great. Thank you for the introduction. Thanks for setting aside some time for this today. You're right. People hate talking about insurance. But what's really funny is once you start having conversations with people, I find that there's a lot of misconceptions about some insurance products out there and the way that they work. So one of the ways that I do help business owners is explaining to them, I think I'm very good at converting insurance into English and explaining things in a down-to-earth, simplified way to make it easy to understand how insurance functions and how it works. So I'm just going to touch on a few topics today that I find are my most frequent misunderstandings or frequently asked questions. The first one is workers' compensation insurance. Workers' comp is required in all 50 states, and it covers employees if they are injured while they are on the job. And that sounds pretty simple and straightforward, but what happens when you have an intern or a 1099 or a subcontractor, and that's where it gets a little interesting. The workers' comp law is there to protect the employee, and the states are very concerned about employees getting injured while at work, and there being appropriate coverage there for them. So the fines and penalties can be very extensive. They're different from state to state, and the minimum requirements for workers' comp varies from state to state. As an example, in Tennessee, I believe you don't have to have workers' comp until you have 5 employees. But in New York, 1 employee makes a requirement for workers' compensation, and the fine is $2,000 for every 10 days that you haven't had coverage. They can look back as far as they can possibly figure out you've had employees. And if a worker is injured while at work, every shareholder may be charged with a felony. So that's pretty important for people to know. And workers' comp is required for 1099s, subcontractors, volunteers, interns, family members. It's intended to be very, very broad. So when the law is intended to be broad. So when the workers' comp insurance companies go and do an audit of somebody's business, they are definitely looking through your checkbook, looking to find subcontractors and 1099s and people like that. And basically, if someone's working for your business, the easiest way to keep this in mind is if they're working for your business, they either need to show you proof that they have their own workers' comp, or you need to provide it for them. That makes it the pretty easiest way to understand that. The next thing I want to talk about is personal umbrellas, or an umbrella in general. It could be over a business or a personal umbrella. Many people have the misconception that an umbrella, like a real umbrella, when you purchase it, instantly covers everything that you have. And that's typically not the case. Typically, what an umbrella does is it increases the limits of coverage you have available, but it does not broaden the coverage you have. So as an example, if you own 2 homes and a couple of cars, and you get an umbrella and you only list your primary residence and the cars on the umbrella policy, that umbrella policy is not extending over your other home. Or if you're a business owner and your primary liability policy has a pollution exclusion, when you buy an umbrella, the umbrella is also going to have a pollution exclusion. So that's a common misconception. People think, oh, I don't have to worry because I have an umbrella over my house. So if something bad happens at my business, it's going to protect me. And that's completely false. That's a very common misconception I see people having. The last thing I want to talk about is not really a misconception, but just to give some knowledge out, is cyber insurance. Cyber insurance is very important these days because of the rise in ransomware and cyber attacks. We hear about them in the news all the time. And, years ago, people thought, well, I'm not Target, I'm not Home Depot, they're not going to target my small business. But that's not the way these hackers work anymore. Their viruses and their code is just constantly surfing the internet, looking for any vulnerability on any system. So they're not targeting you, they're trying to get in everywhere. And once they get into your system, they'll put a lock on your QuickBooks, or they'll lock on your software that runs your business. And now all of your data is being held hostage. They'll very often want to get paid in Bitcoin. A cyber insurance policy will help try to unlock your systems. They have cyber experts on staff that will respond. They will try to save your data. They will negotiate with these terrorists, and they will make a payment if necessary to get your data back. The other thing that's become very, very prevalent is what's called social engineering. So a hacker may get into a business owner's email, and once they're in there, they will pretend to be the CEO. They will ask the bookkeeper to wire money out. The bookkeeper inadvertently participates in fraud, and $100,000 is gone. And once that money gets wired out, you're not getting it back. A cyber insurance policy will reimburse business owners for money that is stolen that way. So that's a great insurance policy to protect your assets. And then the other thing that happens too is a virus will often change the pay to information on legitimate invoices. So you send a legitimate invoice to a client for $25,000, and the client follows the payment instructions on the invoice you sent, and you never get the money. And the one caveat there is that your client is the one who was robbed, not you. They need to have a cyber policy to get that money back, and they still owe you that money. And that makes for a very difficult conversation sometimes when your software sent the invoice and you're still owed the money. So it's important to have cyber for yourself and recommend it for anybody that you're doing business with. And that's all I have for today. My name, again, is Jonathan Carroll with Bradley and Parker. I'm available if anybody has any questions. Thank you.
Well, we're not going to let you off that easy. We do have because I now have a whole bunch of questions for you, and I'm going to work backwards because you started with cybersecurity. So you're saying if I get, I'll call it hacked, and I send Aimee an invoice that has a misdirected form of payment, and she makes that payment and it goes to you instead of to me. See how he's the guilty party. It becomes her cyber insurance policy.
It's her liability. She was the one that was robbed.
And she still has to pay me. Man,
and she still owes you that money.
Aimee, I'm coming for the money.
I know.
And the other thing is, and again, I'm not really asking it, but just let's re-emphasize it, because you always hear everybody say, well, I'm not big. I'm not the local utility company or the phone company or the credit card company. My data is not worth breaching. But the fact is, it's not just getting, let's say, client data, but it's freezing up your company. Like you said, you mentioned things like locking up your QuickBooks account. So it just kind of puts a lock on the company and they can't operate. And so that's the ransom you got to pay, is to kind of get your company back. That's true, right? That's what you're saying?
Yes, exactly.
So when you're out there, don't think of it as you're not big enough. It's if they can block your business and you can't operate, now you're held up. I have to come up. You're held up at cyber point. And then the last question I got for you. You talk about workers' comp. I remember my old days. Workers' comp comes with a variety of categories or classes of employee?
Yeah, they're called class codes. There are thousands of class codes. There's a class code that applies to every job that exists, and your premium is it's your payroll multiplied by whatever the rate is for that particular class code. And so a less hazardous person like a receptionist would fall under class code 8810, and you might only pay 15 cents per $100 of payroll. It's 1.5%. It's next to nothing.
Right,
But
so
if you have a roofer, you might be paying $50 per $100 of pay, which is 50% of the guy's payroll. But obviously a roofer is more likely to get hurt than a receptionist.
and that's something that you would analyze when you look at someone's
Yes,
workers' comp.
we often find misclassified class codes. Sometimes we find problems with what's called the mod, which stands for a modification factor. When you have claims or you don't have claims, your mod moves up or down, and it's multiplied against your premium. So if you create a lot of claims, you're gonna pay a debit on your premium because you have an unsafe work environment. So we can help look at that to make sure the class codes are correct, the payroll being used is correct, and the mod is correct.
And I guess the short answer to all of that is provide safety measures for your employees, avoid claims, avoid higher premiums.
Yeah, we also provide safety training videos. We have hundreds and hundreds of web-based safety training videos for employees, and it's very scalable. So you have a lot of staff. Our software provides a way to track who's taken the classes and who hasn't, and who's passed and who's failed, et cetera. It's a nice suite of HR products that we offer.
All right. Well, thank you, Jonathan. That was very helpful. And so I now want to turn to you, Aimee. Jonathan was talking about, we'll say workman's comp and people getting injured, but the other fact of life is people get sick.
Yes.
You don't have to fall down at work, but you wake up in the morning and you've got a pain. Most people, I should say, get their health benefits through their employer.
Yes.
So if you could say, so what kind of options does a company have, and why is it important for a company to offer medical insurance?
Sure, thank you. And I appreciate being here. So every year, companies shop for their insurance for their employee benefits program. And again, they do not like to see me coming through that door because we all know what's happening in the medical, or I should say in the insurance industry with regards to medical plans. Rates are increasing every year, double-digit increases. Medical inflation is on the rise. It's about 12% we see, and it seems like the carriers are, always dishing out double-digit increases. So we try to come up with creative ways for companies, both large and small, to minimize the costs and offer their employees options for their benefits, because it is important to them. It's a lot of the reason why people do take the positions that they take, because they look at the packages as a whole, and the benefits are a big part of that package. So in New York, there are options. You can be level funded, you could be fully insured, and I'm going to go into that, and self-funded. And the state of New York has a rule that companies cannot be self-funded if you're under 100 employees. So over 100 employees for a company can be self-funded. Under 100, it's what they call community rated. And community rated under 100 is everyone in that certain zip code or in that area, Nassau County, Suffolk, Long Island, downstate, upstate, has the same canned plans, canned rates from the same carriers. So it doesn't really matter. You go into the plans, and if I'm giving, someone in Melville an Empire plan, XYZ plan, that another person in Melville would be getting the same plan and same rates if they're under 100 employees. So I would like to just share my screen. I'm not going to go through the entire PowerPoint, but just some key points about self-funding. We're going to introduce self-funding. I'm just going to kind of go through this fast. But so a self-funding health plan is a funding arrangement where the employer basically assumes the financial responsibility. So what they do is, rather than paying a fixed premium every month, what we're used to, you get a bill from the insurance carrier, you only pay what you use. So you pay for the medical claims out of pocket that the company incurs. So this chart shows you the difference between a self-insured versus a fully insured health plan. So on a self-funded plan, you have the fixed costs, you have the admin costs, and the variable costs, which are the claims costs. But with the fully insured, you're paying the premiums, whether you use the plan or you don't use the plan. Okay, so on the self-funded plan, the employer assumes a risk. You don't know how the claims are going to come in, but you have the insurance to cover those claims. And on the fully insured plans, whether you use the plan or not, you're paying that premium. And plan design, a great tool for a self-funded plan is that you're in control of the plan design. You have all control of the benefits. You can see where the claims are coming in, what you can tweak on the renewal. Are the labs high? Or should I tweak my copays? You are not governed by New York State mandates. So you have freedom and more control of your plan design. Whereas a fully insured plans, as I said, it's more like canned plans, limited plan designs. So you don't have the option to really change the rates and the plan designs. Compliance on the self-funded plan is governed by ERISA, as I said, not state. So you don't have to add the state mandates to the plan. But on the fully insured plans, the state mandates do apply. Again, self-funded plan, I'm just going to self-funded versus fully insured. So again, most large companies over 100 employers, my clients are self-funded. It gives them increased cash flow. It gives them flexibility for plan design. It gives them the ability to see where every dollar is spent. It gives them the ability to tweak the plan design based on their utilization. And it also limits the risk because they do have stop loss insurance to cover the catastrophic claims. So with a fully insured plan, the difference is you pay that premium. It's fixed every month. The insurance carrier collects that premium, whether you use the plan or not, regardless of claims. And a lot of the times, those plan designs are limited. So you have high deductibles, you have copays, and you can't do anything about the plan designs. They are what they are. So again, the benefits of self-insured health plans: reduced insurance overhead costs. You save a New York State tax of 2%. Self-insured programs are not subject to any state premium tax. There's improved cash flow, especially for the first 3 months of claims. The claims are paid when they're due. So if there are no claims, there's no premium or anything being paid, because you pay as they come. Anything that comes in for the first 3 months are usually called the run-out claims, and they're paid by the prior carrier. So usually for the first 3 months, you have a lot of cash flow. So we like to tell our clients to keep those claims and funds in reserve, because you will use them later on in the plan. You have a lot more control when you're self-funded. Greater control, freedom of flexibility over plan designs. Again, you can customize your benefit package. You can have 1, 3, 5 different plans, depending on, how many employees you have. You really have freedom and flexibility, increased cash flow when you are self-funded, and you do know exactly where your money is being spent. It's basically like, why am I going to pay the insurance carrier if I'm not using the plan? A lot of carriers in the state of New York do not even give you claims experience. So if you are over 100, it's nice to get that data, to know where your claims are being spent, to know what you can do to improve the plan, to spend your money wisely. There are some disadvantages of self-funded plans. I say over 5 years, you're going to have one bad year. I mean, that's just the algorithm. You will have a bad year out of those 5 years, but you do have the protection with the stop loss insurance that covers it. So you have to have I would say, we always say, like, the thick skin to kind of play with the ebbs and flows of how the claims come in. So you know that certain months are going to be low, and then you might have a claim that hits. That's a big claim that you have to fund, but you do have the protection of funding those claims with a stop loss premium. Making the decision. So self-funded plans work best for companies that have strong cash flow or reserves, understand the cash needs, and have money available to make the timely claim payments. To administer the plan, we work with many TPAs. We find the best one to suit your needs. The networks that we use are the Cignas, the Empires, the Oxfords, the Uniteds, the Aetnas. So you still have the same networks that you have on the fully insured side. We check the, if there's chronic illnesses, we check the claims utilization each year to make sure that that is the best fit. Sometimes it is not. You have to look at the age, the demographics of your group to do the comparison. But it's definitely something to look at if you are a large group in the state of New York, over 100 employees, especially with the rate of increases that the fully insured carriers are giving you at the time. So at Premier, we help you make that decision, self-funded versus fully insured. There are some plans in between to get you to that next step before you take the plunge into self-funded plans. But it really is an education. We help you get there.
All right. Well, like Jonathan, I have a whole bunch of questions for you. So what you're saying is the self-funded plan really, it gives a company more flexibility, the ability to customize their policy to serve their employees' needs. But the flip side to that is that you carry all the risk. If you have I want to call it a sick employee group that is constantly having trouble, and your rates are going, but your rates are going to go up, your premiums are going to go up. But the idea is that it's your opportunity. And again, I want to hit on that cash flow moment for a second. So what you're saying is during like the first 3 months of the program, there's still a lag time to the processing of the claims that happened, let's say in the fourth quarter of the previous year. And so that's what's really carrying over. So that's why you have a cash flow benefit in the beginning. But as you say, you need to hold on to those reserves, because if ever you were to leave the self-funded program, then you're going to have a double whammy on the back end, because you're going to be paying, again, last year's claims out of a self-funded and new claims out of, let's say, a funded program. So you have to be careful of that.
Correct.
You talked about seeing the claims. Is there an issue of privacy involved in that? In other words, I, as the employer, want to see what doctors you're going to?
Don't see any of the HIPAA privacy information. You just see the utilization. There were 5 doctor visits at XYZ amounts. You don't know who, you don't know what. You do know what, but you don't know who. So they will give a diagnosis.
Oh, so you don't know. Oh,
yep,
so in other words, that's a key. So I don't know that Jonathan's been going to the doctor every other month and running up our self-funded tab, right?
Correct.
Okay.
Yes, not at all. Not
That makes me feel better. I got it. And then I guess one of the other questions, like you say, this is for companies over 100. So it really is dependent upon your employee demographics. If you've got a lot of, how do I say this without being politically incorrect? If you have a lot of older people who tend to go to the doctor more, or a lot of, how do I say this one, younger women who are having babies, because a baby is usually expensive. So if you've got people in those demographic categories, then you need to be prepared to know that there's going to be costs to that, and you're going to see those costs, but not from who.
Correct. Yes, and in the past, babies were the things that we would look at, but nowadays that's nothing compared to what we're seeing as far as medical claims. It's amazing. Like, those were the things we looked at in the past, but now you see that people go to the ER and it's costing $10,000 to $20,000. So that's an amazing. It's amazing what the cost of the insurance is. I should say the medical.
But here's the question. When was the last time you saw medical benefit premiums go down?
I've had groups that have been flat. I will say that. The nice thing about self-funding, I do have them go down, because what happens is at the end, they have a max claim factor. So that max claim factor can go down. So yes, they do go down with self-funding. They can go down.
And so talk about that again. So when you say max claim factor, in other words, let's say that our max claims is $1 million for all of our employees. So if we, and then Jonathan, that's where this umbrella policy comes in, right? And that is that if we go over the $1 million, we have a policy with a premium that covers that.
Correct. I didn't
then-
get into all of that, but yes, so there's a stop loss policy. So let's say the first $25,000, you have an individual stop loss policy. So everyone's got $25,000. So once someone hits $25,000 of claims, the employer funds the first 25, $1 over that 25,000, the employer is reimbursed. Then they have an aggregate stop loss for the whole group. So they're covered, which I've never seen once in all of these years has a group gone over the ag. But that's an insurance policy for the entire group. Yes, so what they'll do is the underwriter will come up with an expected and a maximum. Usually the group falls somewhere in between. But if they go $1 over that maximum, they're covered for that. They will be reimbursed for that at the end of the year.
Right.
So a lot of our self-funded groups, especially this year, there's a lot more market that we could go to shop stop loss than there is to shop a fully insured plan. We only have the Aetnas, the Oxfords, we only have like 4 players in the fully insured market. In the stop loss market, there's a lot more players. So we can play one against the other. So yes, we have seen decreases in maximum claims liability for our fully insured, our self-funded plans. So yes, it's technical, but there has been decreases overall.
Well, I think the biggest learning factor today, and I'm getting it from both of you, is you know what you're doing. We need to have these things. We're required to have, well, I don't know if we're required. Are we required to have group health medical? Group health benefit?
Depends on the size of the group. ACA says yes, if you're over 50 employees, you need to offer affordable healthcare. It has to be more. I could get into the whole thing, but yes.
So then my question is valid, is you have to have medical insurance and you have to have workers' comp, but you don't have to overpay for it. And that's really where the two of you come in.
Correct.
And it's not just about overpaying, well, but it is in the end, but it's about paying correctly. So like I say, it's having the right benefit plan that matches your employee demographics, and it's having the right workers' comp categories, so classes, so that you're paying in the right places, in the right spaces, and then having things like the proper umbrella policy in place, the proper cyber insurance policy in place. At the end of the day, we all understand that insurance is a gamble. It's that you're putting the gamble on them, on the insurance company, and they're covering you. You don't want to have an unexpected expense, especially one of these that could be a rather large expense and can have a significant impact on the company. Over time, you'll pay for your insurance, but your insurance will pay for itself.
Exactly. There's a lot of things that companies can do with HRAs, HSAs, level funding. So there's so many options and creative ways to give the employees the best benefit plan they can and try to maintain and curtail the costs.
And the right answer is having the right, can I call you brokers? Is that okay?
Consultant brokers, yes.
Is to have the right player. Actually, what we talk about is to have the right professional solution partner in place who knows what they're doing to make sure that you have the right coverage. Because just as bad as having too little coverage, having too much coverage doesn't help you either. All righty. Jonathan, any last words?
No, I think this was great, and I appreciate you setting this up. Thank you.
Well, thank you for doing this for us. And again, if anybody is interested in learning more from Jonathan or Aimee, please reach out to me at pspturnkeysolutions.com, and I'm happy to make a formal introduction and help you manage those solutions and make the right decisions. So thank you, Jonathan. Thank you, Aimee.
Thank you, Jamie.
And thank you, everybody, for attending, and have a great day.
Thank you,
Thanks.
Aimee. Thank you, Jamie.
Bye-bye.
Bye.